Yeah. From here, we actually move on to the core finance based chapters, which actually will help us even in our other subjects also. Of course, stats, we use stats in various subjects, equity, fixed incomes, etc. But the core finance calculations which we are going to do in equities or fixed incomes or derivatives, other chapters, they are based exclusively, or even corporate finance, they are based exclusively on the calculations that are happening in this time value of money. Probably this one chapter is the heart of entire finance. The moment we understand this chapter to the core, probably almost all valuations related calculations and all can be very well understood. It's simply based on the fact, with the passage of time, money should carry more value. A dollar of today is more worthier than the dollar sometime later in future. Because if I have $1 today, probably I'll invest it, I'll get some return on it, which may become $1.1 after some period. So if someone is giving me $1 after some period, both are not the same. Having $1 today is more worthier compared to having $1 after, even after one day, because there is one day interest that is added to the dollar that is currently available. That is what is the funda behind time value of money. And this fundamental will help us in terms of, even if I get different amounts at different time periods, virtually equating them, virtually bringing them to the same time period, either today or some future period, and equating two values. See, okay, $1 today. If I say I have two options with you, you have two options. One, you get 100 rupees today, or the second option is I'll give you 108 rupees after 1 year. Which of these two you should prefer? I'm giving you two options: 100 rupees today, 108 after 1 year. Which one should be preferred? Depends on the prevailing interest rate. If the prevailing interest rate is 9% in the market, if I give you 100, probably you are investing it for 1 year and it will become 109 for you after 1 year. So you will prefer getting 100 today rather than 108 after 1 year. Whereas on the other side, if the prevailing interest rate is only 7%, you would prefer getting 108 after 1 year, because 100 today will result only into 107 after 1 year. Now, these two are at two different time periods, but comparison is possible only when I take both of them to the same time period. What am I doing in this example? 100, I am investing for 1 year, 9%. It will give me 109 after 1 year. So someone else is saying I'll give you 108 after 1 year. So I can compare these two numbers. I cannot compare 100 with 108. I should compare 109 with 108, not 100 with 108. That's one of the biggest mistakes people will do. That's where the finance world is different from a typical number-based world. I have to associate interest with time. That is what this chapter is in a simple essence talking of. Even if we are talking of a 1 day passing, that 1 day should have an interest associated with it. And comparisons can be done only when the time periods are same. Otherwise, you either take everything to the future time period or bring everything to the present time period. That is what are the terms called future value and present value. Based on this interest rate factor, take the numbers either to the present or to the future. For example, if someone says, I'll give you 100 every year for 5 years. Simple real world situations. I'll give you 100 every year for 5 years. Versus someone else is saying, I'll give you 300 after 2 years or 400 after 2 years. Which one is better? If I look at it in absolute number case, probably I'm getting 500. 100 every year for 5 years. Whereas in the second case, I am getting only 400. Right? But it may so happen that 400 is more preferable. I'm not saying it is. But it may so happen 400 may be preferred to 100 for 5 years. Or it may be so happening that 100 for 5 years is better than 400. Both of them, both the cases are possible, depending on what are the prevailing interest rates. Right? So, because the amounts which we get in our real world are at different time periods, I need to have a mechanism to compare across various investments which are occurring at various time periods, and that comparison is possible when I bring all of them to the same time periods, either to today's value equivalent or to a future some value equivalent. That is what is the essence of this entire story. So all the calculations which we would be doing in this chapter are primarily with the assumption of that. And all the calculations of this chapter happen with your calculator itself. Right? So though the formulas and all those things exist, but as far as our exam is concerned, if we are comfortable doing the things with a calculator, there is nothing else required out of this chapter. And this will form the basis for your many other chapters in CFA L1, L2, L3. Right? Almost the entire calculator usage gets covered through this one single chapter itself. Alright, so let's move ahead in this chapter. Whenever we use, so the heart to this chapter is interest rate, because with the passage of time I have to associate interest rate factor. Finance people look at interest rates from 3 dimensions. One is the rate of return. If I deposit something, how much interest I am going to get on my investment. That's a typical interest rate. 2, discount rate. Discount is, if I get something in future, how much is it equivalent to today? If the prevailing interest rate is 10%, 110 after 1 year is equal to 100 today. So that 110, I am discounting it by 10%, which will give me 100. Which will give me 100. So that interest rate is being used as a discount rate in that scenario. What is, so if someone gives me the current amount and asks me to find out the future amount, then I call it as a rate of return. If someone gives me future amount and I want to equate it to some present amount, what is its equivalent value as of today? Then I use it as a discount rate. The prevailing interest rate in the market itself, I use it as a discount rate. This is the funda which is used in almost all investment scenarios. The discount rate is a very common word in the finance applications. 3, opportunity cost. How much interest I am foregoing. Probably as simple as saying, if you have to spend 60,000 on CFA fees, you are foregoing some interest rate. You could have deposited this 60,000 in a bank, which will earn some interest rate, right? That is what is your opportunity cost. By investing here, you are foregoing an opportunity to put that money somewhere else and get some benefit. That is also called as interest rate. So interest rate is used in the concept of rate of return or discount rate or even your opportunity cost. I will give you 1000 rupees after 1 year. Or I have already given you a scenario. 100 for 5 years versus 400 after 2 years. Which is a preferred one? I have to look at the interest rate. Find the equivalent of those two types of investments as of today. So what is the equivalent of 400 that comes after 2 years? What is the equivalent of that is today? Probably 350. 100 for 5 years. What is the equivalent of it today? Let's say 370. So then I'll say the 100 for 5 years as of today is 370. When I discount it probably at some percentage. At the same percentage when I discount 400, which is after 2 years, it's equivalent to 350. So probably I'll prefer the first investment compared to the second investment. Right? So whenever a future number is given and I have to find out the equivalent of it today, I use it as a discount rate. So almost the next chapter and all other chapters, we use words like discounted cash flows, the net present values. They are all the concepts which are based on the discount rate funda itself. Then another way we have to look at the interest rate is nominal rate versus the real rate. Nominal is, it includes the inflation also. When we say the bank is giving me an interest rate of 10%, the 10% includes for inflation also. If I remove the impact of inflation, that is what I call as the real return. So if the nominal rate of return, if the bank is giving on an FD, it is giving 9% return, inflation is 6%, then my real return is only 3%. Right? So we always we have to be very careful whenever we are talking of return, whether we are talking of nominal rate of return or the real rate of return. Right? If we are talking of nominal rate of return, even our profits and cash and whatever we are having, it should be in the nominal term. Right? When we say the future, someone is going to give me 1000. The 1000 should be inclusive of inflation. When I use, let's say 9% as my discount rate, the 1000 which I am using should be inclusive of inflation. When I use 3% as the discount rate, the 1000 I have to remove the inflation factor from that 1000. Right? So the most of the business world uses nominal rate only. Right? Of course, in some forex related transactions and at some specific places we talk about real rates. But most of the finance world talks about the nominal rate itself. Look at your salary world. You got a hike of 10%, but inflation is 8%. You actually got a hike. I mean, though your salary has gone from 10,000 to 11,000 bucks, your expenses have gone up from 8,000 to probably by another 8%. 8,600 something. So your savings has actually gone up only by a marginal amount. Right? So that is what we are trying to talk of here. The real growth rate is the real rate of return which you have got is only the 2%. Right? In some cases, if your salary has gone up by 10%, but the inflation is 15%, all the costs have gone up by 15%. You'll sometimes crib saying, even though this increase of 10% is of no use for me. right? That is what is the real rate which we talk of. Though there is no real increase, there is no real return that I am getting if there is an inflation in the market. But the real, the actual quoted rate always, whether it is by banks or any entities, they quote it with the inflation. So simple way, simple logic, if the inflation is high, you will find that the interest rates will be higher, because the interest rates will add up the inflation. If the inflation is high, the interest rates will obviously be higher, right? And there is a very common word which we will use in the finance world, which is the risk-free rate of return. We have used it for our Sharpe ratio kind of calculations and all also. Without taking any risk, zero risk, there is still some return which we are getting, like your government securities, banks, the nationalized kind of banks and all, which actually include for inflation. It's not real risk-free rate, it's a nominal risk-free rate, because that includes inflation. When a bank is quoting 9%, it may be risk-free, but it is not real risk-free, it's a nominal risk-free. It includes inflation, right? So real risk-free rate is always a virtual entity. There is no such entity called real risk-free rate of return. Whenever we talk about the risk-free rate of return, we are talking about a nominal risk-free, which will include for inflation. But if we are talking of some other securities, even along with inflation, there might be some other risks that are included. So the higher the risk, the higher the returns they have to give. One could be because of maturity period. The longer the maturity period, I am blocking my money for a longer period. So it's like I am taking a big risk by putting this money with you for 5 years. I don't know when you will close your shop and go away. Right? The bank wise, you may shut down your bank after 1 year and you can run off. So I am actually risking my money by keeping it with you for 5 years. So definitely the only motivating factor for me is if you give me a higher return. So one is for maturity risk. There are various risks that can come up. And the more the risks coming up, the more the return that is going to add up. But a risk-free is without any risk, no scope of losing money. The return which I am going to get is what we are calling as the risk-free rate of return. So nominal risk-free rate is always equal to real risk-free rate plus the expected inflation. I mean, instead of simple addition, this is like a ballpark formula. The actual formula is like this. 1 plus real rate of return into 1 plus inflation is equal to 1 plus nominal rate of return. Both of them will lead to more or less the closer answers. But this is the last one is an exact formula. The one above it is an approximated formula. Quickly you can do like 9% is the nominal rate of return, 6% is the inflation. Quickly you may say 3% is the real rate. But the exact value is like, if I say 1 plus real into 1 plus inflation, 1 plus 6%, which is 1.06, is equal to 1.09 nominal. So 1 plus real will come out as 1.09 by 1.06, which will be very much closer to 1.03. It will be slightly lesser than 1.03, but it will be very close to 1.03. So if I want exact value, I have to do this process. Approximate is 9 minus 6, which is 3. Right? Now, yeah, this is the first set of calculation we talk about. Sometimes, even with banks, this happens. The compounding, and to be clear, the entire world of finance believes in compound interest, not simple interest. Almost all calculations which we work on from now onwards any, whether it is equities or fixed incomes or derivatives or corporate finance, any calculations we talk about, the focus is on compound interest, not simple interest, where interest gets interest. Interest is levied on the interest. So there is a kind of accumulation of the money that happens. But this computation of the interest can happen at non-annual intervals, like banks. If we look at our typical FDs or something, they say the compounding happens on a quarterly basis, or compounding happens on a monthly basis. The rate which they put up, right? If they say the interest rate is 9.5%, this 9.5%, if it is, or probably 10%, let's make it simple. If they say 10% is the interest rate, 100 if you are depositing today, it should give you 110 after 1 year, right? But what you will get will be slightly more. If you are depositing 100 today, and if the bank has quoted that the interest rate is 10% per year, you should get 110 after 1 year, but check out your investments, you will get slightly more than that. The reason is they quote 10%, but here it will be mentioned compounded quarterly. When I am saying compounded quarterly, it is like, it's not 10% per year, it is 2.5% per quarter, right? So per year it gets compounded over compounded. So the how much it becomes is what is given by this formula, and that is what we call as effective annual rate. If the compounding frequency is not annual, to make it annual, I compute what is called as an effective annual rate, which is simply given as 1 plus periodic rate to the power number of periods in the year minus 1. So here 1 plus 2.5%, periodic rate is 2.5%, to the power number of periods in a year, number of quarters in a year is 4 minus 1. So if I actually compute it, it gives me a number of 1.025 to the power 4 minus 1, working out to 10.38%. What I would be getting is not 10%. What I would be actually getting is at the rate of 10.38%. Especially, so whenever I say effective annual rate is 10.38%, but the banks will not say 10.38% at all. They still quote it. The quoting is only as per annual rate itself. Any instrument, the quoting of the rate should be as per the annual rate. So 10% per annum, compounded quarterly. So the effective, what the investor gets is actually 10.38%, not at 10%. So if there are like two investments, again, one bank says 10.2% compounded annually. This is where the difference comes out. One bank says 10.2% compounded annually. The other bank says 10% compounded quarterly. Which one I need to invest? These are very complex decisions. 10% compounded quarterly is equal to 10.38%. Whereas 10.2% compounded annually is 10.2% only. So actually that bank is giving 10.2, whereas this is giving 10.38. But the quoting, both of them has to do it on annual basis itself. So these guys have quoted it at 10, that guys have quoted it at 10.2. But the compounding frequencies are different for both. This is where probably I remember a very classic example of these gold loan companies. Very recently, I think 1 year back or something, they have started one campaign. I think you know the names. They have started one campaign saying 1% per month. Gold loan at 1% per month. Right? Whereas there are a couple of banks at that point of time which were offering a gold loan at 12.4 or 12.5% per year. And this was offering at 1% per month. From which one I need to borrow? Bank 12.4. This 1% per month doesn't translate to 12% per year. It actually translates into much more. How much is it equivalent to? So again I have to find out the effective annual rate. 1 plus periodic rate to the power number of periods in a year minus 1. 1.01 to the power 12 minus 1, which is actually 12.68%. Which is actually 12.68%. They are actually charging an interest rate of 12.68%, whereas the bank is charging only at 12.4%. Right? So, to evaluate these kind of stuff, understanding the effective annual rate also plays an important role, because different investments, they compound the numbers at different frequencies. But you have to compare. Again, comparison can happen only if brought to a same level. All compounding. So that's where effective annual rate helps. You are taking everything to the annual. If it has been annual, what is it equal to? So the 10% quarterly compounding, if it has been annual, it will be equal to 10.38%. Like that. Right? Now, once this is known, it becomes very easy for us. Now, there are some other definitions here, not too much. One is an annual percentage return, which is just like 12%. 1% per month, so 12% per year. That is annual percentage return. We are not bothered, finance world, except in very few investments, they are not bothered about the annual percentage rate of return. Annual is just frequency multiply. So it does not matter what is the compounding frequency. If I say 10% per year, compounded frequently, quarterly, 2.5% per quarter into 4 quarters. It's again 10% only. So when someone is going with annual percentage return kind of a model, there is no change with the compounding frequency. But finance believes heavily on effective annual rate, which will get impacted with your compounding frequency. Now, we talked about as the compounding frequency increases, the interest rate keeps increasing. If it is annual, let's say if it is at 10%, right? Annual compounding. Annual compounding, let's say it is 10%. If it is half yearly compounding, what is it equal to? 5% per half year. So 1.05 to the power 2 minus 1. Right? So this will become 1.05 to the power 2 minus 1, which is equal to 10.25%. Correct? If it is quarterly, we have already got 10.38%. If it is monthly, right? So it becomes 1 plus 10% by 12 to the power 12 minus 1 monthly compounding, which is making it 10.47%. 10.47%. So as the compounding frequency is increasing, the effective annual rate of return is increasing. Now, if I make it daily compounding, 1 plus 10% divided by 365 to the power 365 minus 1. This is equal to 10.51%. Not too much of a difference if you see. It is increasing, but slightly. From annual to semi-annual, there is a difference of 0.25%. From semi-annual to quarterly, there is a difference of 0.13%. 10.25 has become 10.38. From quarterly to monthly, another 0.11%. Monthly to daily, another 0.05%. Right? Probably hourly, minutely, secondly. Right? And if the frequency is too large, probably hourly, minutely, if the trading is happening every minute, like your stocks or derivatives, where the trading is happening every minute, it's always better to do the compounding on a very close interval basis, not even daily, right? So that is where we call it as continuous compounding. Again, we have looked at the words continuous and discrete. When there are infinite number of values, we call it as continuous. So the continuous compounding has come out from that stage. The formula which I use for continuous compounding, like in our discrete compounding, what we are doing, 1 plus that annual interest rate divided by number of periods, that frequency, number of compounding frequency, to the power number of periods in that year minus 1. Now if that number is pretty large, the formula will get upgraded to e power, it goes as e power the annual rate minus 1. Instead of 1 plus, you in your calculators you have a formula for e power x. Your calculator directly computes your e power x. So all you have to do is, you simply do e power 10% minus 1. APR is 10% only across. E power 10% minus 1. This is also becoming 10.52 only. So what we are saying is, the maximum with the compounding frequency, the 10% can go up to 10.52%. It cannot go beyond that. 10.52 is more like if the compounding happens every minute, every second, every microsecondly, you will get 10.52% return. Right? So that is what we call as a continuously compounded rate of return. Especially the derivatives world uses heavily this continuous compounded rate of return. Whereas even the other worlds, bond worlds and various other worlds also use the continuous compounded rate of return. Whereas the stock markets and these kind of returns, they frequently focus on the discrete itself. 1 plus the interest rate divided by the compounding frequency to the power number of periods minus 1. Right? Continuous compounding is nothing but if the compounding happens at a very minute intervals of time. The formula directly becomes, instead of 1 plus that kind of a formula, it directly becomes e power APR minus 1. Now this is what you look at in your financial calculator. Most of the things are pretty much common. But the key thing as far as the financial calculations go is this line, where you have 5 different fields, N, which talks about number of periods, right? Number of periods, number of years, number of periods. I by Y is interest per year. PV is the present value, which is the today's value which you are either depositing or receiving or equivalent, whatever it is. PV is the today's value. PMT keep on hold for some time. I'll come back to that. FV, I by Y, interest per year. FV is a future value. At some point, what I get, like if I deposit 1000 today, how much will I get after 2 years at some rate of interest and all that stuff? 100 will be the present value because I'm depositing it today. Whereas what I get in future is what I call as a FV. So the moment or to now, even if I talk about 20 calculations from this chapter, they use only these 5 fields. All calculations from this chapter, they use only these 5 fields. So probably let's focus on these 5. Any calculation you think of, okay, PV, FV, then I by Y, N, and PMT. So PV is like today's value, present value, whether it is deposited or received or equivalent. If 1000 is received after 3 years, what is the equivalent of that today? Present is today's value, today's worth. The whole world of valuations depends on this concept called present value. Future value is anything not with respect to today, even tomorrow or after 10 years. So these two are more associated with lump sum money, one time today or one time in future. I am depositing something today. How much will I get after 5 years? It's like a lump sum. Whereas if I talk about regular repeated installments, same amounts, same intervals of time, that is what actually gets classified as annuity. The term annuity is associated with 2-3 things: equal amounts, equally spaced intervals of time, like insurance premiums. I pay equal amount at equally spaced intervals of time every year. Probably a house rent, I pay equal amounts at equally spaced intervals of time, first of every month. Probably at least up to 1 year the rent is fixed. So at least until that period I call it as an annuity. Equal amount, equally spaced intervals of time. It could be 1 month, 1 year, 2 years, 5 years, but whatever. The payments, the intervals should be equal and the amounts need to be equal. Then we are calling it as an annuity. If I send some kind of an annuity in my question, I will put it as a part of PMT. I will input it into the calculator under the PMT. If it is a one-time lump sum payments or receipts, I'll put them either as PV or FV. PV is if it is happening today, FV is happening after n number of years. That n number of years is what is specified in n. After how many periods? So look at it as periods. after how many periods, and this is interest for the period. Look at it as interest for the particular period, which means if the compounding is quarterly, take it as quarterly interest. If this is quarterly interest, this will become 4 quarters in a year, right? So these three should point to the same time period. Installment wise, if I am making a monthly installment, the rate should be a monthly rate, N should be in terms of months. I have to make sure these three belong to the same time period. Not all problems will have PMT in them. Because if the question is, if I deposit 1000 today at 5% per year interest, how much will I get after 1 year? There is no installment payment at all. There is no repeated regular payments at frequent intervals of time. It's a one-time lump sum payment. So PMT will not exist for those kind of problems. But wherever it exists, I have to make sure that the I by Y and N should define the same time period. Right? And if they are not there, at least I by Y and N should point to the same time period. If I by Y is quarterly interest rate, then N should be number of quarters. Right? And the way I input the numbers into the calculator is, first type in the number and press the corresponding button. Right? Let's say 100 is the present value. First I will type 100 and click the PV button. That means it is assigned, PV is assigned to 100. Similarly, if I want 5 years, we'll take some examples that will practice it off. If I want 5 year is the time period, you press 5 and then press N. It will then write N equal to 5. PMT equal to 450. Right? And one more thing to notice here is, whenever there is a cash outflow, payment happening, depositing or these kind of meanings, where the cash is going away, we put a minus sign before the number. And the way to put a minus sign in this calculator is, if I want minus 450, first type in 450 and then click on this plus minus button. This is what will create a minus 450. Not the minus sign. This is a typical arithmetic. 450 minus something is what it will become. But if I want minus 450 to be typed, first type 450 and then put the minus before it. Right? That will give you minus 450. Wherever there is a cash outflow, put it with a minus. Cash inflow, put it with a plus. Right? That's one more thing you have to be comfortable with. And it's always better to reset your calculator. What do I mean by resetting? There is a chance that your past values may be retained, which will give a biased calculation. So whenever before we are starting, it's better to reset it. Two things we have to do. You press this second. Along with second is, whenever you are pressing second, it will execute the ones that are above the button. Second is like shift in the typical scientific calculators, right? It will execute. So probably you can press the second and you press reset. The plus or minus, the reset is there on the top of that. So you press second and reset, then press enter at the top. The second button from the top is enter. So everything is reset. All the values are reset. And one more thing that is better to look at is setting the number of decimal places. Because some calculations, the answer could be in 4 decimals or 3 decimals. So setting the number of decimal places is also important, which can be done Again from second and press this star where the format is there. Second and format, and there you can specify, let's say 4, 3. The moment you type in some number and then press enter, it will talk about those many decimals. When you say second and format, and after that you type in 3 or 4 or 5 and then press enter, it will be set to those many decimals, your calculator. Otherwise, by default, it will show 0.00. Only 2 decimals after the decimal point after you reset. So it's in case you require some numbers with 4 places after the decimal point, some answers are there with 3 places or 4 places after the decimal point, then it's better to set the format accordingly, right? Once that is done, you are ready for your calculations, right? So we'll take up a few calculations and try to execute them using these 5 buttons. Okay, let's start. And almost the moment you are clear with this funda, this chapter is over, right? You should be comfortable solving all the questions, right? So let's take a few examples. Of course, towards the end there is something more, but most of the questions will be derived with these 5 fields only. So let's try out using our calculators. In 10 years, what is the value of 100 invested today at an interest rate of 8% per year, compounded monthly? Now, what all information we have out of those 5? Time period is how much? Compounded monthly. So 120 months. So that number should be 120. So you make it as 120 for n, right? Type 120 and then press n, which will become n equal to 120. Then what else information we have? Present value is there, 100, but I'll have to type minus 100 because I'm investing today. There is a cash outflow from my side. So I'll have to type it as minus 100 for a PV. PV is equal to minus 100. Then what else we have? At an interest rate of 8% per year. But I have to make it monthly because it's compounded monthly. So I'll make it as 8 divided by 12. 8 divided by 12. So I'll do 8 by 12 first in my calculator and then assign it to I by Y. First do 8 by 12 and then press I by Y. Do a simple 8 divided by 12, assign it to I by Y. So I by Y will be probably 0.6677%, whatever it is. So this is my I by Y. Probably it should show similar numbers for you also. So if my answer matches with your answer, you have executed it correctly itself. Now what is that I need to find out? What is the value after 10 years? So I want to find out the future value. So you say compute, there is one compute button. The first one, the first button, CPT. You say CPT FP. You should get your future value. Sorry, this 0.67% is I by Y in my case. So I'll compute the future value. So my future value comes out as 221.96. This is the same number you got. So the 220, which means if I am depositing 100 today for 10 years, it should be equivalent to 221.96 at the end of 10 years, going with a monthly compounding. Right? So this is how we solve all the questions. The moment we need to identify which number goes where, and all the questions can very well be handled. See, if you don't reset, what happens is, now you have entered these 4 values. Now, for example, for some of the calculation, you don't enter FB. I mean, for a new problem, let's say there is no FB at all. FB is 0. But you don't explicitly enter FB as 0. So what happens? The system takes FB as 221.96 and it does the remaining calculation. So for that, from that standpoint, it's better to reset it. Otherwise, what happens is, I have to mandatorily give zeros for the remaining fields. PMT, here it's not existing. I have to mandatorily give 0 to PMT. Just to avoid that scenario, I am resetting it. Right? So in some cases, because these values are already existing, probably if I forget typing I by y, let's say for my next problem, I by y is 1%. But somehow I forgot typing 1%. The system will give me the answer based on 0.6%, whatever, this 0.67% itself, because that will be persisting. So the calculate, though I don't compute, though I don't enter 1% next time, it is still giving me an answer because it has already persisted with 0.67%. So from that standpoint, it's better to reset the calculator values always. I mean, that will even give you a flexibility in quickly entering the data. Probably you don't need to set the decimal format every time, because not all times you may require it to that level of decimal. But yeah, if you want it, it's better that you set even the decimals also with every question, because sometimes if the question is about find the interest rate, it gives you like 0.12, your answer will be 12%. But if I increase the decimal, it may give 0.1232. So it actually becomes 12.32%. So especially if the interest rate related questions are there, it's better that I have a higher decimal point, decimal set to an increased number. But for other calculations, wherever money related calculation is required, two values after the decimal point is very much sufficient also. But yeah, you will also get a comfort level in using the calculator. The moment quickly you are able to reset and quickly you are able to change the decimal, at least for the remaining questions, and for the speed of usage of the calculator, it becomes more easy. Now let's look at the second one. Given an annual 11% annual rate compounded quarterly for 2 years, compute the future value of 8,000 today. It's the same calculation. 8,000 today. So PV is minus 8,000. Then what else? Annual rate 11% compounded quarterly. So I need it as a quarterly rate. So the quarterly rate 2.2575%. And he is asking about for 2 years. 2 years is equal to 8 quarters, because everything should be in terms of quarters. So 2 years is in terms of 2 years. 2 years is equal to 8 quarters. So I am trying to find out the FE. How much is it? 9939.04. Is it working out to the same number for you? Put minus 8,000 for PV. Do it as 11% by 4 for I by Y. And N8 as N. And do compute FV. It should give you 9939.04. Got it? So that's how we proceed with our calculator. So we need to have an understanding of these 5 values. That's it. Of course, annuities I did not start. Annuities will be starting from the next. Okay, look at the next one now. Just try it out from. Not getting it. Next one. An investor invested 10,000 into an account 5 years ago. Today the account value is 18,682. This you have to go with your, not with the PVFVs. E per e to the power of 1 plus rate. See, it is like 10,000. If it is for 5 years, it becomes e power 5r. R is annual rate. 5r is for 5 years. E power RT. Simple way. 10,000 into e power RT is equal to 18,682. So calculating wise, e power 5r is equal to 18,682 divided by 10,000, which is 1.8682. Whereas now if I want 5r, apply logarithm. So it becomes logarithm of 1.8682. So how do I get logarithm? You have one button on your, this one. You have the button of ln. There is one button called ln. So you make 1.8682 and press ln. So 1.8682, you press ln. This is the value of 5r. So r is becoming this number divided by 5, which is around 12.5%. The interest rate for this period is 12.5%. If I am looking at on a continuous compounding basis, the interest rate is 12.5%. So simple way is your present value into e to the power of RT is equal to future value. If the question is on continuous compounding. Present value into e to the power of RT. R is your annual interest rate. T is the number of periods or number of years. Because I am talking of annual interest rate. Annual interest rate, number of years. If we are talking about quarterly interest rate, number of quarters. E power RT is equal to your final value. Based on that, you have to apply your logarithms and arrive at the final value. That's not the regular calculator problem. But this is a slight, when the continuous compounding kind of questions are there, the regular calculator scenario will not work. Yeah, look at the next one. Future value is 2000. All right. Future value is 2000. I need it after 18 months. If she can earn 6% compounded quarterly. So what should be my I by Y? 6 by 4, 1.5. 1.5 needs to be my I by Y. All right. And what else is given? I want it after 18 months. But I don't want this data in months. I want this data in quarters. Because my interest rate is quarterly rate. So the N should be in terms of quarters. 18 months is 6 quarters. Right? 18 months is equal to 6 quarters. So N I will set it to 6. Then what should I compute? How much must be deposited today, which is the present value. How much has to be deposited today is nothing but I have to calculate the present value. So do it and let me know. How much is the present value you are getting? 1829.08. So if she deposits 1829.08 today at 6% interest compounded quarterly, after 18 months she is going to get 2000 rupees. Right? So it's only about framing the problem, giving the numbers from the English. From the English statement, you translating them into numbers is what is very much important. Now look at, so almost all investment problems can be solved quite comfortably the moment you are able to put these 5 fields in. We have not yet looked at the PMT part, but at least, so look at the next one. A local bank offers a CD that earns 5% compounded quarterly for 3.5 years. Depositor places 5,000 deposit. What will be the amount? So, I mean, you don't need to do it. You can practice these things. There is a PV minus 5,000. Because I want it quarterly, the interest rate will become 5 by 4. 1.25% will be my interest rate. And the number of periods, 3.5 years, I have to convert it into quarters. 14 quarters. So with this, I'll get my value and I'll say compute FV. Almost all similar problem. Now we'll introduce to the annuities, where we said it's a recurring payment, equal amount at equal intervals of time. That is what we call as annuity. In the annuity, people talk of 2 types of annuities. One is a regular annuity or an ordinary annuity, and 2 is an annuity due. The difference between the 2 is, in a regular annuity, whether it is payment or receipt, happens at the end of the period. Here there are multiple payments, right? At the end of the period, if the payment happens, we call it as a regular annuity. If the payment happens in advance, at the beginning of the period, like house rent, the payment happens at the beginning of the period. Beginning of every month, I have to pay my rent. Whereas the EMI on a loan, I pay at the end of the period. I borrow a loan today, I don't pay interest today. After 1 month, I will pay my first interest. Right? So, which means at the end of the period, I am making some payment, which are called as regular annuities. If I am making the payments at the beginning of the period, I am calling as annuity dues. Obviously, for an ordinary annuity, the value is lesser compared to an annuity due because I am making the payment today only. At the beginning of the month, if I am paying the same money, it's as good as I am paying more compared to paying the same money at the end of the month. Because time value. Every month, I am losing out on 30 days of interest. So, the value for a regular annuity is always lesser compared to an annuity due. Now, how do I calculate these two things? In calculator, whether it is regular annuity or annuity due, it is handled through the PMT button itself. But the difference I will make is, if the question talks about if the question is regular annuity, I don't need to make any change to my calculator. By default, it works in the regular annuity mode itself. But if the question talks about annuity due, I have to change the calculator setting to a begin mode. What is this begin mode? You see above PMT there is something called BGN. That is like a begin mode. So you press second and press PMT and enter, the calculator gets set into the begin mode. So then you can enter your numbers as it is. That mode, it should show on the top BGN in small font in that glass bar, in that glass area, it will show BGN. Then it is like calculator is set in the beginning mode, which means it is only applicable for annuity due calculations. If the calculation does not involve annuity due, again reset it back to your end mode. Only otherwise you will get misleading calculations altogether. So by default it is in the end mode itself. Only when there is a begin mode calculation we have to take care of that. Right? So let's look at some of the numericals here. Yeah, to set it into the annuity due mode, you press second and PMT, which has begin. Then it will show SCT at the top. Set. So set button, then again second and set button, which is enter. Set button is nothing but enter, because enter and set are there. So second and set will show BGN. Just press enter, you will see BGN at the top. So then the calculator is set into the begin mode. It's applicable only for your annuity due calculation, but the regular annuity you can directly go with the basic initial setup itself. So let's try to solve some of these numericals here. 45,000 car loan financed at 12% over 4 years. What is the monthly car payment? Like a EMI. Now what all numbers I have? At the end all these will boil down to those 5 numbers only. PV is 45,000, not minus 45, because I am taking the loan. Money is coming to me today. So PV is 45,000. So that part is fine. Okay, PV I'll make it as 45,000. Fair enough. Then what else? N is monthly payment. 48. N is 48. I by Y is 1. Right? 12%, but it's a monthly compounding. So Just not to get confused with things, only these 5 formulas. Though they have introduced P by Y and all in the calculator, we don't need to bother about all those stuff if we are able to convert these things perfectly. So the I by Y is 1% and N is 48 periods. Now what do I need to find out? And compute PMT, because I need the recurring payment. How much has to be done? So I'll do a compute PMT. So there is no FV, because after 48 months there is nothing to be paid. Everything is paid as an installment itself. So there is no lump sum to be paid after 48 months. So it's as good as FV equal to 0 itself. Right? Okay, so this is the rate. How much you got? 1185.02. Whatever. The slight here and there could be of the rounding related stuff. So I have to pay an interest EMI of, sorry, there is an interest also that is involved. If that is the case, why do you need to use the calculator? Right? EMI includes the interest and principal both combined together into equal installment. You would be probably paying more than, a lot more than, let's say this number into 48. If you do, you're actually paying 56,881. So almost 11,000 odd, or close to 12,000 you are paying in the form of interest over the 4-year period. If you look at a typical housing loan, probably your loan is for 20 lakhs, but you will end up paying 46 lakhs to the bank. Because the loan is taken for a 20-year period, the interest will supersede the principal altogether. So, I mean, to calculate those kind of things only, it's very essential to put it in this format. Only these 5. All numericals can be handled. And the whole world of finance, a big number of calculations can handle through this. It's only the finance converting into these numbers is the very important aspect. The biggest of the calculations, including your valuations and all, they follow the same fundamentals. Fundamentals are simply the same. Okay, just look at a couple of more. 10 equal deposits, 1000, are made into an investment account earning 9% starting today. How much will you have in 20 years? Yeah, this is a slightly tricky question. This has some. Okay, we'll put it one more step later. Let's look at the next one. After we do one or two more, we'll come back to that. If an investor puts 5724 per year starting at the end of the first year, so it's a regular annuity, into an account earning 8% and ends up accumulating 500,000. How many years did it take the investor? So I have to find out N, compute N. So we have PMT as minus 5724. So we'll put PMT as minus 5724. I by Y, this is a yearly only, so I don't need to change it. So 8% and FB is 500,000. Right? So the interest rate is 8%. FB is 500,000. There is no PV. I am more interested in finding out N. So compute N. How many years? 27. Yeah, 27 years. is the total time period it will so if you are depositing 5,700 every year for the next 27 years, it is going to become 5 lakhs, right? Probably you are depositing only like even if I take 6,000, 5,700, 6,000 for 27 years, you are depositing much lesser than 2 lakhs, but it is becoming 5 lakhs because of the compounding, right? Now, next one we can just read out. An annuity will pay 8 annual payments of 100 with the first payment to be received 1 year from now. Regular annuity. Interest rate is 12% per year. What is the present value of this annuity? What all data is there? PMT 100 plus 100. Interest rate is 8 annual payment. So 12% and N is 8. 8 years. So I have to find out PV, which is the same. You can do that. Now look at the second one. Second one is a slightly typical problem, which is more reflecting a real world scenario. This is where drawing timelines becomes very important. Now, what all are the things that are happening? 10 equal annual deposits of 1,000 are made, starting today. Now let's draw the timeline for it. Once we draw the timeline, we can apply appropriate formulas. So, this is the 0th year, which is today. Correct? 10 equal deposits are made starting today. So, until how long? 0. So, that up to 10 years. 10 years or up to the end of 9 years. At the beginning of the 0th year. The second one is at the end of 1 year. Third is at the end of 2 years. Right? Beginning of the second year is the end of the first year. Right? So, because you are starting it now, when is your payments happening? By when are your payments getting over? The starting of the 10th year or at the end of the 9 years. So, if you set it to the begin mode, right? Setting it to the begin mode is one thing. 10 years, you are finding out the PV. But that will give you the value at the end of 9 years or at the beginning of the 10th year. Correct? You are talking about a 10-year period. If you set it to begin mode, it will give you the future value at the end of 10 years. Right? Beginning, but he is asking about 20 years. So it's like a two-stage problem. First stage, you will compute it with respect to 10 years as an annuity. Because from 11th year, it's no more an annuity because there is no equal payment. No equal intervals of time. The years are 20, but the payments are only 10 and they are annual. Right? So, what is that I need to do here? First, I have to compute up to 10 years. And after 10 years to 20 years, I'll take it as lump sum. Whatever the FV that comes, that will become the PV for the next 10 years. Getting it? That will become the PV for the next 10 years at the same rate of interest. I'll have to find out the FV after 20 years. It's like a two-stage problem. Right? First set so we'll try doing it. First set the calci into the begin mode. So only for the 10 years we will do as a annuity due. First 10 years is an annuity due. The value whatever we are going to get is at the end of 10 years. 10 to 20, there is no payment. But whatever got accumulated, it will still accumulate interest for the next 10 years. Right? That will be like a, not PMT, it's like a PV. Right? So let's try to put these two phases into the problem. So 10 equal annual deposits, 1000, 9%. So what all are available here? PMT is minus 1000. The I by Y is 9 and N is 10. Now which will give me my FV? You have to set it into the begin mode. So tell me what is your FV? FV is 16,560, right? 16,560.29 will work out to your FV. If you have not got it, we'll have to pause it. So whatever the calculated amount that you have got, you press a minus and make it equal to PV. So in the next stage, your 16,560 will become your PV and 9% will be your interest rate for another 10 years. Because this is the value at the end of 10 years. At the end of 10 to end of 20, no PMT is applicable. So I have to directly find out the FV. See, the begin or normal does not have any influence if there is no PMT. It doesn't matter at all. Only if there is a PMT, the begin and the end modes have an influence. Because the second part does not have any PMT in it, you can continue from the existing location itself. But make sure that the PMT is set to 0, otherwise you will get a wrong answer. Because you are not resetting it, make sure that you press explicitly 0 and press PMT. Otherwise it will take that PMT and it will give a separate, it will give a different future value. Right? So just calculate. I'll also do the calculation. So you should match with my answer. So the final value of this project is 39,204. All right. So the different timelines. Some questions will have different timelines like this. So we should be able to understand that the complex question in a time value of money problem is like this, where there will be a different time frames and I need to understand the time frame and solve my problem accordingly. Now, yeah, this is also more on the similar terms. Just look at the first one. Second one, you can try doing it. An investor will receive an annuity of 5,000 a year for 7 years. The first payment is to be received 5 years from today. The real problem. If the annual interest rate is 11.5%, what is the present value of this annuity? Same as your previous. So what is the timeline? The payment is received for 7 years. Right? 7 years. And the first payment is 5 years from today. So 0 to 5 years there is no payment. Every year from the 6th year onwards 5,000 for 7 years, like this, right? So this 7-year period is an annuity. Find out the present value only up to that, up to the 5 years, right? Or up to 4 years, because the first payment is received 5 years from today. So probably if I shift 5 years from today, you have to try handling the problems like this. Shift yourself 5 years from today. Then you are getting the first payment. So you can make it as annuity due. 5,000 starting today. I mean, imagine that you have moved 5 years in the future. Then that 5,000s are more like annuity dues, which are for 7 years. Or you can very well say, I'll move only 4 years from today. These two should give me the same answer. Either I move 5 years from today and treat 5,000 as annuity due and solve the problem, or move 4 years from today, treat it as regular annuity and solve the problem. Getting the two logics? If I move 5, because the first payment is 5 years from today. If I move 5 years from today, the first payment is happening today, which is like annuity due. I have to find out the present value of the annuity due as on that period, which is 5 years from now. But I want it as of today. So from there to today, it's like a lump sum. So that will become my future value. I'll find out the present value as of today. Or I'll shift myself only 4 years from now. Then all the 5,000s which are coming at the end of each year. So it's like annuity regular. Whatever the present value that comes, that will become the future value. And I'll discount it by 4 years, not by 5 years. Both of them should give me the same answer. Right? Let's try out this. Got the logic, right? So we'll try to execute it. That's what is the complexity that can be created in these problems, nothing more than that. So now, so in this example, first thing is I'll shift, okay, both. I'll shift 5 years from now, treating it as an annuity due. So my PMT will become 5,000. N is 7 years. I by Y is 11.5%. I by Y is 11.5%. So I am calculating FV, or I have to calculate PV. The present value as of the beginning of the 5th year, or as of 5 years from now, which is the ending of the 5th year. Right? 5 years from now is ending of the 5th year. So here I'll get PV $25,851.47, treating it as an annuity due. Now this will become my FV for the remaining period. This will become my FV for another 5 years. So, and there where the PMT does not exist, 0. Now I'll find out my PV which will give me which will work out as 15,000. So it's as good as saying if I deposit 15,000 today, right? If I deposit 15,000 today, I will be receiving 5,000 a year for 7 years, starting from 5 years from now, right? This is when we are going with an annuity due route. But let me go with a regular annuity route, I should get the same answer. Otherwise, there is some problem in my analysis. 5,000, 7 years, 11.5%. These three are same. Now the PV, when I go with a regular annuity route, means I should set it in the end mode itself. In that case, it is coming out as my PV is coming out as 23,185. So this will become my new FV for 11.5% for 4 years. This will be for a 4-year period. So from here, if I find out the new PV, it becomes it becomes 15,000.68. So you have to just visualize the problem. Whether you treat it as regular annuity or treat it as annuity due, you have to be very clear. Okay, if I move 5 years from now, it becomes an annuity due. But if I move only 4 years from now, it becomes a regular annuity because the payments are getting received at the end of each period. Right? So, depending on which one you are comfortable, if you say, why should I set it into begin mode always? And if I forget it becoming a problem, better you shift yourself only 4 years from now. You can just develop that kind of visualization. Why not shift only 4 years from now, then treat it as a regular annuity, solve the problem, make it again as the another layer problem, because these are the regular problems of our day-to-day investment. I invest, there are some investments which say invest only for 5 years, but you take your benefits after 20 years. So in these kind of problems, it's not a full annuity for the entire period. It's annuity only for a certain period. But the total time period is something else. So in those kind of problems, we need to identify the timelines properly and based on that solve our question. Right? Of course, we do have some more things in it. We'll break it here. We'll take, of course, major part is over, but there are some EMI related calculations and all which are very important. So we'll spend some time tomorrow on this, and then we'll go on to the discounted cash flows. Right? Because